Welcome back to the voice of the private sector and the second hour of Brian Buschlach's Business Briefing.
At 3 minutes now past 8 o'clock across Puget Sound. Hope you had a great weekend, and it is time to get down to business. For those of you just joining us, you missed a great interview with Pam and Will Levinson at Papina Swimwear in our first hour. Head to our website, mynorthwest.com. You can download that podcast, and we'll post hour number 2 here just past the top of the 9 o'clock hour. Want to set the table for you here real quick. We've got Michael Lortz from Geffen, one of the top CPAs in the entire region. Big changes with Washington's B&O tax. We'll get to that in just a sec. Also, Greg Bell, author of Water the Bamboo, joins us in about 30 minutes. We've had a huge response to Greg's segment and want to thank him for his input on the show. This week, a segment I promise you won't want to miss. That's coming up at 8:32 here on AM 770. And we'll wrap up in Portland's Pearl District with kettlebell trainer Michael Skog, swinging those bells with the top kettlebell trainer in the entire country. That's coming up in about 45 minutes. First, though, I want to thank everybody out in Woodinville last night who attended the auction of Washington wines. What an amazing evening it was. Sherry Swingle and her team at the auction, another amazing job. One of the best events in the entire region of the entire year. Also, want to thank Bob Betts and Stein Cruz. They co-chaired the event again this year. Think we can get them to do it a third year in a row? We'll see. But great job by those gentlemen. And thanks to all of you who attended. We raised well over $2 million for Seattle Children's Hospital. What a great cause. Had an opportunity to stop in Seattle Children's on Thursday and pay them a visit this past week. So great cause and a great time last night out in Woodinville. Hey, we've also got a big announcement from Seattle Business Magazine. I'm going to get that to you here in a little bit. But first, let's turn our attention to the world of accounting. It has been a very busy summer. I know you think your CPA takes the summer off and he's on the golf course. Well, that's not the case. It's been very busy for the men and women in the world of accounting this summer as so many closely held family businesses grapple with transition planning. Now that things are picking up, well, the older generation, they're thinking maybe it's time to pass this on. We talked to Michael Lortz at Geffen about that. A little later, he's got good news on Washington's B&O tax. Michael, the economy is bouncing back, and we're hearing more and more about business owners talking about transition. And I find this interesting because there was the big push at the end of last year to get estate planning done. So many people did it, and there's like this echo boom now of secondary estate planning talking about transition. Why is that?
Sure. Well, there's really two types of businesses I see getting transition, Brian. One are closely held businesses where they're trying to transition to the next generation. And in that context, what we're seeing is that estate tax planning is still very important. Many folks think that that's no longer relevant because of the increases in the federal limits. But Oregon and Washington both have relatively low estate tax limits. $1 million for Oregon, $2 million for Washington. So in the closely held business getting passed down to the family standpoint, very relevant conversations still.
Well, I think the attorneys that we work with in our practice, obviously this is very high on their radar across Puget Sound and the Portland market that this is out there. But I think from a client standpoint, this tends to sneak up on them because they have done their homework on the federal level and they think that they're done. Lo and behold, they're not. It's even more onerous at the state level.
That's absolutely right. In fact, one of the things that we find is that people can start to make a lot of assumptions. They might, for example, think that life insurance planning isn't relevant anymore, when in fact it can still be very relevant. The state rates for estate taxes are not insignificant. Both Oregon and Washington start at 10% rates, and they climb up as high as 16% for Oregon and 20% for Washington. So the state rates on estate taxes are very significant and require a lot of planning to reduce.
Michael Lortz from Geffen Mesher joining us here on Business Briefing. I'm Brian Buschlach. Glad you could join us for this conversation as well. If you own a closely held family business, this is something you definitely need to look into, and we will give you Michael's contact information at the conclusion of this segment. You said it's been a busy summer, and I know a lot of the work has been in this regard. It's been a busy summer for us as well, and typically even August we'll see a bit of a slowdown. That has not been the case this year. Give us kind of the pulse not only on your business, Michael, but the business world in general, those that you work with. I get the read that things have really picked up across the region.
Yeah, that's the same read we get as well. In fact, we find that firms in a wide variety of industries are much more active. This year we're doing a lot of consulting with companies that are trying to do deals, that are thinking about transition. People are thinking about growth. So it's very much out of survival mode now and into the planning mode. You know, we've already talked a little bit about closely held companies transitioning, but I'm also working with a lot of firms, service providers. They also have transition issues, and it's not so much to the next generation of a family, but it's to the next generation of owners, key employees, for example, folks who are moving up the ranks. So we've been spending a lot of time, particularly with professional firms such as architects and engineers, helping them figure out how can the existing owners retire and get adequate value while at the same time leaving behind a firm that is very strong and can continue to produce income for those key employees who are going to be taking their place.
I know it's tough to be specific in that regard because it's going to depend on the company, how it's structured, how many partners, et cetera, but typically how are these professional firms accomplishing this? Because I know it's a dilemma, especially for those in smaller firms.
Yeah, that's true, and there's really a variety of ways of accomplishing it. One thing we find is there's always concepts that people have heard of that they're very interested in. So, for example, ESOPs. Those are something that's very popular in the press. We oftentimes will have companies that will come to us and say, should we consider an ESOP? And we help them with that analysis. And occasionally it makes sense. Many times the administrative costs will tend to give people pause. So there's other ways of transferring equity to key employees rather than all of the employees in the firm, if that makes more sense. You can do some sort of stock purchasing program. You can use loans. There's a lot of ways to transition that equity. I think what I always tell folks that are about to become owners and take the place of those retiring, what I always tell them is you're going to end up paying for it one way or the other. Either you're going to buy that equity directly from the person retiring, or the company will be paying that person off, and you'll be paying for it in the form of reduced earnings for a period of time.
It's an interesting topic. For those of you just joining us on Business Briefing, Michael Lortz, Geffen Mesher joining us in this conversation. And it's really an interesting time, Michael, because we see so much of a transfer. And I think this is true across Puget Sound and the Portland market, where we have the generation of professionals in their late 60s and early 70s who steered their firm through the Great Depression 2.0, as I call it, the Great Recession. Now they're looking at saying, hey, things have stabilized, business is back. Now I can, take some time off or try to transition out to this up-and-coming generation of late 30s and early 40s businessmen and women, professionals who are ready to take this over.
Yeah, that's right. And what you find is you've got some of the generational differences in terms of priorities that we hear about in the press as well. So what you find is that there may be folks who are retiring from those firms that have devoted significant, substantial portions of their time and energy for many years. And some of the folks coming up behind them have a little bit of a different view of the firm and of what we would always call work-life balance. And so sometimes you find that it may take two new owners to replace the one that's leaving, just because the one that's leaving has dedicated so much of his or her life to that organization.
When does this conversation start? I know that's kind of a trick question because it's going to depend on the business and where they're at in that cycle, but sooner rather than later, I would hope, right?
Yeah, sooner's always better. When the conversations should start and when it actually tends to start often are not the same. Many times firms will start to think about this when they've got, 2 to 3 years left before folks want to retire. And that can work, and we can work with that scenario, but it would be better to start even earlier than that. I think it's very important to establish a culture within organizations as to what to expect from an ownership standpoint. How does somebody become an owner, and what mechanisms are in place to accommodate that transition?
That's Michael Lortz at Geffen Mesher. When we come back, good news about Washington's B&O tax.